Hello and welcome to the Mutual Fund Show. My name is Niraj Shah, and it is the first day of the month. And last month onwards, we told you that for the next six, which is this is the second month in a row, wherein what we'll try and do is try and get in Raghav Iyengar of Access AMF to talk about a category or two and give us try and explain to us in detail about what that category actually means, what the category actually does, and what kind of investors is that category suitable for. It is almost like a classroom. It is almost going back to basics, and he's here with us to talk us through two very important hybrid fund categories, if you will, which is the balance advantage category and the multi-asset category. Raghav, did I get that correct? Those are the two
Absolutely,
categories that we are
absolutely,
trying to do today.
absolutely. Yes. Good afternoon, Neeraj. Yes, you got it spot on. No problem.
Okay, great, Raghav. Thank you so much for joining in. Viewers, keep in mind, in about 15 minutes, we'll also get in one more expert to try and tell us his view about what are these categories like and what are the different kind of funds within that category that you can look at as well. But first, let's get going with these. Remember, the balance advantage category and the multi-asset category again form a part of the larger umbrella of the hybrid category of funds. Raghav, great having you. And we decided last time that we'll do the six categories of hybrids within over a period of 3 episodes.
Absolutely.
And I can safely say from the response that we got for the first episode that people were wanting to know in detail about the entire category and they didn't get bored. So I'm as
Okay.
much looking forward to this episode as well. What do we start off with? Balance advantage funds?
Balance advantage is the flavor of the day, Neeraj. Let's go for that because uh, that's one of my favorites too. Also, actually. So
Okay, so
really,
why so? What is this category about? Can you give us a brief primer?
so Amit, if you remember, Neeraj, we talked about SEBI coming up, the regulator coming up with a set of subcategories within mutual funds. Large cap, mid cap, small cap, recently multi cap, flexi cap, etc. So in the hybrid space, this is actually the most recent addition. And since this category, frankly, did not exist even maybe it just came into life during the formal categorization there, when it happened. Now, as the name suggests, there are two names to it. The generic name is balanced advantage or dynamic equity. Uh, in some sense, if you remember, we spoke about hybrids. So hybrids are nothing but a mix of debt and equity funds, investments put into the same scheme in varying proportions. Now, in balanced advantage is by its nature an equity fund, which is that at all points of time it will have 65% plus in equity and equity related instruments. Now, what's the unique thing about this category is that the fund manager or the portfolio manager or the fund house has the ability to reduce what is called the unhedged equity, which is what we call the open equity. If you remember last time we spoke about arbitrage. So let's say if markets are very high, as people are feeling they are today, the model shows out that you have to reduce your equity exposure. Say equity exposure is brought down to about 44, 45%. The 20% is put into arbitrage funds, so the total becomes 65, and then you have about the difference between 65 and 100 is kept in debt. Now, if you remember, why do people do all this? For two reasons. One is, when the beauty of a hybrid category is that it is two different asset classes, equity and debt. They tend to sort of move in different directions at different points of time. So ideal for somebody like a conservative investor who does not want to put all his money into equity at a particular time, but at the same time wants to enjoy the experience of an equity investment. So in some sense, it's a great category in today's time because most of the people I speak to today, it's a worrying bull market. If I may talk to people, so whether you talk to senior portfolio managers or you talk to research analysts or you talk to man on the street, everyone's got that standard question that, "Arey, abhi 60,000 ho gaya, abhi kya kare? What to do? What to do? Is it time to take out? Is it time to put in? What should we do?" They want to put in money, but at the same time, they are a little worried about the market fall. So in that sense, this category of funds or this balanced advantage category is in that sense a perfect place for people who want to do that.
Right. So, how would the categorization, or how would the differences be, Raghav? I mean, uh, when if in order for a balance advantage fund to have taxation of 65%, naturally 65% has to be in equities at all time,
Absolutely,
right?
absolutely.
Which
Yeah,
would
has
include
to be.
pure equity and arbitrage both.
Absolutely, yes. That's the thing. So the beauty in balanced advantage funds is that most fund managers or most fund houses have models to sort of figure out where their equity allocation is, and these are what I call pro-cyclical or what is counter-cyclical. Now, this is more complicated, but it's essentially a pro-cyclical view is something like a momentum-based view. That is, you see the trend of the market, and a counter-cyclical view is when you look at valuations in the market. So obviously, the natural theory applies is that when valuations are high, obviously people want to bring down equity exposure. You bring down the total exposure, but at the same time you top it up by adding some arbitrage to give the entire 65% view. Now that's the trend. If you look at the trend, and there are four lovely boxes. So if you see if the market valuation is low, but the trend is unfavorable, typically this is where typically equity managers are there. But if you look at the extreme right hand corner, that's favorable for equity. Say sometime last year, maybe sometime let's say April, May, June, just around the time when after the COVID thing bomb hit us, you found that market valuations were low. But if you find that the trend is unfavorable, like it was maybe in the first couple of months of post COVID, then obviously your equity allocation is less. So fund managers or fund houses tend to use a mix of these two styles to try and figure out where their equity allocation should be. And then obviously the balance, which is 65 minus that allocation, is put into arbitrage. And of course, then the remaining part is put into debt. You can go up to, I mean, some fund managers even go up to 75-80% in equity. Today, uh, so like our Access Balanced Advantage Fund can go technically 0 to 100 too. So in that sense, it gives a lot of freedom to the fund manager to decide on where his equity allocation should be, depending on market valuation. So why is this category so popular, Neeraj? Because ideally today it sort of fulfills that one big question that, hey, what do I do? Market is high. And, we all know that ultimately asset allocation is a very, very fundamental way of trying to get a better investor experience. That's what the whole hybrid category does. But in this particular category, because you can go all the way from, let's say, 30%, or in some cases even zero, to all the way to 100, in some sense, you are delegating that responsibility to a fund manager based on a particular model, and that experience should be better. Most of the times, as retail investors, you tend to sort of buy high, sell low. I mean, actually, the converse should happen. You should actually
Yeah,
buy low, sell high. But that is something to do with behavior, right? So typically, very few people were able to sort of come back. Many investors actually came into markets, and that is a beauty between April, May, June last year. This is the data talking. If you go to Amphi website, you will see industry got pretty strong flows in that period of time, but many people jumped off the train somewhere around this time, August, September, October, November. September, October, November, actually the redemption sort of took off because everybody had this perception that, hey, markets were at whatever, they had almost given a 30-40% return from the place where they invested, and they really didn't envisage it going further up. But you know what happened after that. In the last 1 year also, the index is up very, very smartly, and there are a whole host of reasons to that. So that's the discipline part of it, and for
hmm.
many investors, that discipline is difficult to practice. Apart from the
So
fact that we all lead busy lives, and it's difficult for us to sort of get there and sort of make, how do I put it, in the sense, uh, do it on a regular basis. I think very few investors are able to see it. So you see, the category is actually very, very large. It's almost 150,000 crores. In fact, in the last 2 months, the maximum amount of money has actually come into this category. So in some sense, the Indian investor, thanks to channels like yours and thanks to to things that we're doing today, because I think the education levels are so good. People are very interested in trying to figure out what their funds are doing, or what they're doing, what people are doing with their money, that they're able to actually get into these products maybe whenever markets are high. So that is what I have noticed in my experience. That's ever since this category has come in, when market valuations tend to get a little higher, and obviously the headline index numbers are much higher than what people think they should be.
got
This
it.
flows this this category sees a huge amount of money. So in that sense, it's the youngest category, Neeraj, but it is In the entire hybrid space, it is the number one AUM category today.
Not surprising. The remaining 35% split between
That's no, that this fund it just goes to debt. The next
straight
one
away
that
to
we're
that.
going to be talking about, which is triple advantage or multi-asset funds as we call
Multi.
it, typically there is an element of debt plus equity plus
Okay.
typically a third and a fourth asset class. So that
Oh, that's
sometimes
okay.
can be gold, can be REIT, etc. So that's a fundamental difference between the two categories. In that sense, they are similar, but largely in terms of equity valuation, the triple advantage largely, or rather the multi-asset largely stays pretty much anchored at the higher ranges of equity. It's not as dynamically managed as let
Got
us
it.
say the balanced
No, no,
advantage category.
just before we get there,
Sorry,
sorry,
sorry, I'm
sorry,
so
just
sorry.
before we
Yeah,
get
yeah, I'm
there,
sorry. I'm
there's
jumping in.
just
Yeah,
one quick question, Raghav. What are the, I mean, would the over a over a over a period, would the returns of a dynamic or a balance advantage fund be much better than say a pure equity fund or nothing like that? The reason why I ask is some people will say equities will always score over a period of time, but however, there will be others who will say that if you are able to manage the high and the low equity exposure very, very well, then typically the returns could actually be higher because 65% I don't think is the minimum, right? 65% is the 65 is not the maximum, it's the minimum.
it's
On a
the
good
minimum. Yeah,
equity cycle,
you
when
can
the
go up to
markets are
80. Yes.
lower, you
Yeah,
can go
yeah.
higher as well on the equity
You can go
allocation.
ahead. Yeah, you can go up to 80%. Yes. In fact, in some
So what
schemes
about
now
the
you can
returns?
call. I think the fact is that returns come out of two parts. So one is obviously the entire asset allocation process. The other part is obviously the entire stock selection and the way you look at equity, right? So it's unfair to compare both of them. But yeah, uh, if you were to look at the way I would look at this fund is for the amount of risk you're taking. I think your risk adjusted return as compared to a pure equity fund will be much much better because of the fact that you're able to adjust the equity levels depending on market conditions.
Yeah, viewers, that's a very powerful statement simply because a lot of us want the returns but don't want the volatility associated with
Absolutely,
equity in the
absolutely.
purest raw form. And at that point of time, that's why Raghav is saying the risk adjusted returns would be fabulous. Now, Raghav, since you gave us a quick sneak peek into the other category, you might as well now dwell fully into it. So
I have
that is
one
the
last point, Neeraj, which I like to make on this category, which is my standard
sure.
one, which I use for all hybrid funds, right? And more so specifically for this one because of the fact. See, as you know, when we spoke about the various categorizations. So you know that let us say large cap fund has to have a minimum percentage in large cap stocks, a mid cap has to have a minimum percentage in a balanced fund, or actually in any hybrid category. That choice or that ability is there with the fund house. So I can potentially have much higher levels of small cap or mid cap or large cap in my fund, unlike it being determined by other things. And the same thing can happen with fixed income too. So as you know, fixed income, you can buy triple assets, you can buy double assets, you can buy 1 year assets, you can buy 10-year assets. Most of the fixed income categories have some restriction around them. So let's say a short-term bond fund will not, you cannot have a duration of more than 3 years. Whereas again, in the debt portion, in the hybrid fund, and specifically in balanced advantage funds, because you're allowed that discretion, one needs to be a bit careful how one selects a fund. Because when most of us or most of the people, what they do is they go and do a research phase, they do a top-down search, and they say who's the one who's giving the best returns over a 1 year, 3 year, 5 year period. That's great, but in this category, what you really need to figure out is that how is that fund done when markets have actually gone down, and they've gone down because the guy or the investor who's coming into this fund is somebody who is a conservative investor. He's not looking to get 100 on 100 out of his equity. He wants to participate, he or she wants to participate in equity, at the same time not take that complete risk. So please
All
remember
right.
this. Don't do this top down stuff which most of us tend to do, go into various places and just check how is the 1 year
Mhm.
return and how is the last 6 month return. Anyway, one should not do that because the fact of life is past returns are never indicative of how the future is going to be. That's much more complicated. But in this particular category, one needs to be that much more careful because every fund house has their own model. Every fund house has their own style of putting equity or debt. And some people put a lot of a lot of access. The focus is to buy more large cap. That may be somebody may not know that, and if let's say hypothetically large cap doesn't do well in the last 6 months, it will look like a failure strategy. But I think the key thing that you must understand is that how is the fund done, or how is the scheme done when it actually when the returns are, when the markets are down, and that's actually where
Hmm.
you should sort of put more emphasis on that. Yeah,
Okay. So that point is well taken. Now,
thank
Raghav,
you.
the difference between the multi-asset category and balance advantage.
So multi-asset is a beautiful category. It's actually a go anywhere you want category, if you ask me to, because you can literally have gold, you can have equity, you can have really much. So as the name rightly suggests, and this is something that uh, the regulators really cracked it, because I think this category used to have all kinds of weird names around it, but I think very clearly uh, it is now very easy to understand. So as the name very clearly suggests, I think this is a category which can have many different asset classes. Now, by that I mean it could be having gold, you could have equity, you could have debt. Of late, there is a new category on REITs and what we call investment trusts and InvITs. So these are two new categories that have just emerged, especially in the last 5 years. There are a lot of issuances, a lot of activity happening around it, and I think it's a great story if you were to look at it over a period of time. So today, an asset manager can then really build a multi asset portfolio. Now, why do people do this? Why do we complicate it? The same logic which we started off, if you remember, in the hybrid space, that ultimately asset allocation is a very key component of how the investor experiences. And if you put in a set of assets which don't move in tandem with each other. Typically, when you see even like right now, what's happening, for example, for the last 1 year, equities have done very well. Gold has done actually nothing. In fact, it's negative, right? It's a negatively correlated category. So when you mix these assets up, and then what it tends to do is sort of give you a much more longer term, a slightly more conservative investor experience. So hopefully, or rather, when equity falls, debt goes up, or vice versa. So you mix match these categories, and in that sense, if you are, it tends to have a much better experience. Now, many people do this on their own intuitively. You will have equities maybe through a mutual fund or through a direct equity platform. You will have debt through maybe a bank deposit or maybe other asset classes. Gold is, of course, a family heirloom in terms of India, but many people buy gold, especially in festive seasons like what is coming to us now. And of course, of late, a lot of retail investors are participating in InvITs and REITs. So through property. Many of us have direct property investments. Now, of course, there is a different way to do it through the capital market. This fund actually, or these type of funds, Neeraj, actually put all that into a single fund. So it's a very interesting asset class, and I think as and when more asset classes keep getting added, in the past largely it has been largely gold, equity, debt. Of late, as I said, investment trusts and real estate investment trusts are the new additions. But I think as more and more assets keep getting added, this will become a truly unique category.
So, Raghav, suffice to say that the result or the returns out here might still be lower. Potential returns could
Yeah.
still be lower,
Yes.
but it is an all-round investment
All
option
round.
because
Absolutely. Yes. Yes.
person gets everything at one go.
Absolutely. It's an all-rounder fund in terms of your total asset allocation. So somebody says, I don't have any of these assets and I want to have exposure to all these assets and I want to just invest 5,000 bucks, I think, or 1,000 rupees or 10,000 rupees. With 10,000 rupees, you will not get any substantial participation in anything. I mean, maybe mutual
True.
funds will give it to you in equity and debt, but if you want to go and buy, like, say, 10,000 rupees of gold, you hardly get any grammage out of that. Or, real estate in Bombay, 10,000 rupees will not even get you a tile. So, if you want to put that and you know it's participating in these asset classes at a finite amount, yeah, a very small amount of money.
Got it. Last question, Raghav, before we thank you. And is there something that you're doing differently at Axis for this category vis-a-vis some of the other funds in the market out there?
Axis has a triple advantage fund, which actually was one of the first funds in this category long time back. So we're doing a mix of debt, equity, and gold leader. And I think in some sense, we have a really lovely long-term track record. And again, as I said, when markets get a bit choppy and people are a little confused as to what to do with it, and they also want a little bit of gold, because there are a lot of traditional investors who like gold, and gold is a great defensive asset class, especially in times like this when there is so much of money being printed across the world. So it's a hard asset, as they call it. But that's it. So that's where we are. we are actually really talking a lot about our triple advantage fund there. And if you go back and look at the track record, it's got a stellar track record over the last 10 years. And yeah, I think investors, especially of the conservative kind, are really liking this idea.
Great. Raghav, thank you so much for taking the time and explaining both of these
Thank you.
categories in detail, I might add. And
Thank you,
we
Neil.
look forward to having you same time next month, maybe around
Thank
after Diwali, to try
Yes,
and
yes,
understand two more categories.
yes, perfect. Thank you, Neeraj. Thank you, Bloomberg. And yes, happy learning, everybody. Stay safe.
Yeah, thank you so much. Happy learning every day. Happy learning every show. Yes, indeed. Now, well, that was the view from Access AMC. But as we make it a standard practice of our show, that we also get somebody who looks at not just one house, but multiple houses to try and understand what is his or her view on both these categories. And within these categories, are there funds which she or he believes are good bets for each of you? So that's what we'll try and do today. And to do that, we have, for the first time on the Mutual Fund Show, Santosh Joseph. He's founder and managing partner at Germinate Investor Services LLP. Joins us right now on the show. Santosh, great having you. Thanks for joining in. Thank you for coming on the show. Um,
Yes, yeah,
Unfortunately,
hi
Santosh,
Niraj.
now I can
Hi.
hear you. So thank you
Yeah,
for joining
this
us on
is
the show.
thank you. So this is a classic first time I got myself muted. Uh, it's not my first time watching your show, so I'm glad that I could be live with you. So the pleasure is mine. Thank you.
Uh, Thank you. Santosh, we had Axis AMC just before you talking about two categories within the hybrid structure, which is balance advantage as well as the multi-asset category. Any quick thoughts that you have here? And then we would want to understand from you which of these practitioners within these category do you, within both of these categories, do you admire the most and why? But first, a view on what kind of for what kind of investors are both of these categories suitable?
Niraj, first things first, I heard Raghav speak about it, and I think he did a great job in explaining those things. These two categories are the categories of the future. Now, you already saw over the last decade how the balanced advantage, many were called by different names, but this is the hybrid equity category where equity and debt is dynamically managed, has taken the entire mutual fund flows by storm. Now, we are also going to see same thing happen in multi-asset. Many mutual fund companies either actually have a scheme or they're looking at a scheme or they're reworking on some schemes to manage the multi-asset. Like how you had the balanced advantage or the dynamically managed equity category come right on top as we speak today in terms of flows, in terms of the practicality and the applicability of the product to the larger audience. I believe we are a couple of years in the pipeline to see the multi-asset category blossom into such a big category. Now, while you were speaking about Access Triple Advantage, I agree they were one of the first ones almost a decade ago to come with more than two assets in one category, which is equity, debt, and gold. Today, you have multi assets which have maybe another one or two additional assets that make the entire mix interesting. Both of them are being able to solve a very critical challenge to the investor, which is, can I stay invested irrespective of the market movements? Can I stay invested irrespective of the good times or the bad times in the markets? I think that is the reason why these two categories, one, are successful, will continue to be successful, will see massive inflows in the coming days and years ahead.
Are they, how do I say, are they not suitable, for example, for certain investors? And let me qualify my question. Let's assume there is an investor who's forget age wise, but young, let's say, has got many years of say investing life ahead, and she can take risk or high risk. Is it advisable for such an investor, because she wants higher returns, is it advisable for such an investor to not opt for these? And that's how I'm qualifying the question. So what kind of investors are these funds not suitable for?
I think right way of asking that question. I think this is not suitable for people, especially investors, who have an absolute clarity of thought in what they want. See, we also have to be honest with ourselves that many investors think one thing, do one thing, and expect a very different return. If you're young or old, if you understand equity, you want the right equity exposure, you are okay with the volatility, you're okay with the drawdown, you're also okay when there's a massive upside and you don't feel like selling out and you're going to be a long term investor, then multi asset and balanced advantage or dynamically managed equity are not a category for you. You take the allocation call yourself, you take the call to enter, you take the call to exit with absolute clarity of thought. These two products or categories is for people who are not very sure of their asset allocation, who are not confident of taking a call, and who are not confident of staying through the market cycles or even investing through a market cycle.
Thank you for explaining it in such succinct words, Santosh. And viewers, uh, believe me, there is no shame in accepting that you are not completely sure of timing the market or taking the allocation calls, because it is not everybody's business. Your business might be being a technician or a software engineer or what have you, and therefore you're good at that, and that's more than enough. Leave these calls maybe to somebody else. Um, uh, would you believe that by virtue of the fact that the multi-asset um, allocation funds, Santosh, now have more than two or three categories attached to themselves, then while they give more diversity in asset base, their quantum of returns would, on a normalized basis, be lower than a pure balance advantage fund. So the reason where I'm trying to get it again is that as an investor, if I want diversification, but I don't want excess diversification, then would that excess diversification come at the cost of some returns?
Yes. So there are 2 points in this. One, multi assets give you slightly more diversification than one you possibly can do yourself. Two, maybe that you want. You will compromise a little bit on the return only on an absolute basis. But on a relative basis, you will not. Let me use gold as an example, which is possibly the mainstay in multi assets. If you were to be looking at gold exactly a year ago from where we are today, you had gold at over 20% return. As we speak, the last 1 year return on gold is a negative 10 to 12% return. A year ago, you were motivated to invest in gold. Today, you're not motivated to invest in gold. Therefore, multi assets removes that risk, ensures that you have a sort of a very dynamically managed gold allocation through the cycles. The second part, that why you should look at it in conjunction with the risk you take and the return you get rather than only the absolute quantum of getting maybe 2 or 3 percentage points lower, is that we all have a certain finite capacity in taking that mental ability to take. This is what I call mental exhaustion. You may be good when you start off with asset allocation, moving between debt, equity, gold, maybe international equities, maybe REITs, or maybe just actively managing over here. Over a period of time, once you get used to your portfolio, we all go through what we call a mental exhaustion. You give up, you slip up. That's when multi assets stand up for you. That's when actively managed funds will, look different, and then you will realize it didn't matter whether I made 1 or 2% less as long as I was still in the game in the right fashion.
And this is such a pertinent point as well, really, viewers. It may not appear as evident, but I think over a period of time, it certainly becomes the norm rather than the exception to the rule. Santosh, may I urge you, if you are at the liberty, to not give us an exhaustive list, but maybe two or three names, and not in a definitive order, of funds which you think are good as an investment bet for both the balance advantage fund category as well as the multi-asset category. Standard disclaimers: people who hear you will do their own due checks and diligences before they go out and put the money, if they do indeed put the money in the first place. And again, two, this need not be the all encompassing or your favorite list. You're just giving us two or three names out of the total number of funds that you may have in store.
See, I'll give you 2, 3 names, and I'll give you the names last, but I'll give you the reason why I believe the names are important, right? So when we look at dynamically managed equity, that's what I'd like to call it. They're called as BAFs. Now, interesting part is each and every asset management company is got a model that they swear by and they believe is better than the market. Number one, that leads to a certain equity, debt, and arbitraged or the hedged exposure. Number two, that leads to you choosing also some bit of how you manage equities largely, large cap, mid cap, small cap. Three, it also tells you, are you pro momentum or against momentum? Are you contra or are you just going with the flow of the market? The third and the fourth, very important, is how much dependent is this model on a fund manager or on a metrics that you are going to apply. There are some people who will say, listen, I have a model. Until the model is triggered or breached, I will not touch it. Some will say, I have a model, but my fund manager has got a discretion with so and so constraints. Some will say, no, my fund manager will decide based on how it is. So therefore, why am I going to say these few names is because all of them possibly give you an opportunity to diversify within that category. For example, let's assume that I start with looking at Axis Balanced Advantage Fund. Now, I'm comfortable with Axis because they have their model which is working. They were moving from a 40-day trading days average into now a flexibility for the fund manager to move. The second option one could consider is maybe a DSP, Dynamic Asset Allocation Fund. They have a model. They have a model which is proven in the down times and in the up times. Then to add little diversity, you move to, let's say, a HDFC fund. They've been aggressive. So through the last 1 year, I think about a year ago, their equity allocation was maybe north of 80. Now they may be closer to the 60s odd level. Now, if you look at the two different balance advantages fund, one being at 35-40, one being at 80, tells you that there is a divergent view in how they're looking at the market and the position it offers from a 1 year, 3 year, 4 year standpoint. Then you add, let's say, an IDFC balanced advantage fund. Now, I also like to think that at some level, one has to keep in mind the size of the fund. Right now, I'm going for the couple of big ones and the couple of small to medium ones, which have the ability to also have the flexibility to maneuver all these given said paradigms and make that balanced advantage truly a dynamically managed equity fund, which is to reduce risk and optimize the return. Likewise, if you come to multi-assets, let's say we start with Axis and then go on to look at who are the other ones who offer this. Look at Nippon. Nippon has got a multi-asset fund which says that I got international equity, I got Indian debt, I got Indian fixed income, I also have gold. Now, the minute you have international equity, you also at some level get some sort of exposure to even the dollar or the foreign currency. So it becomes multi-asset at one added level of foreign currency also built into it. Now, similarly, you also have Motilal, which gives you a similar multi-asset experience, but there instead of managing equities actively, they manage it through a ETF, where you have the Nasdaq, the S&P 500, the Indian actively managed fund, and Indian debt fund, and gold as well. So HDFC, Motilal, Nippon, ICICI, Axis are good bets for multi-asset. Whereas in the balance advantage category, you take Axis, you take DSP, you take IDFC, you take HDFC, maybe even an Edelweiss. They've done phenomenally well, and they're one who have followed the pro momentum call. So these basic reasons are one that makes me select the fund, and sometimes I even ignore how the returns alone play out, because what is important is selecting these metrics more than who's performed well over the last 1 year or 2 years.
Well, Santosh, I don't know why it took us so long to get you on the show, but I'm glad that we did, and looking forward to have you more often. But firstly, thank you so much for coming on the show today and giving us
Thanks,
such
Niraj.
wonderful details.
Thanks, Niraj. My pleasure.
Pleasure was ours, and viewers, thanks for tuning into this leg of the Mutual Fund Show.